Investing feels amazing when everything's going up. Ever caught yourself mid-rally thinking, this feels a little too easy? Whether it's stocks or crypto, a green portfolio can make you feel invincible. But the market has a habit of reminding us that we're not. When euphoria takes over, caution fades, and markets can get overexcited. Big rallies are often followed by equally big pullbacks. History shows it again and again, yet still, people get caught off guard. So, in this video, we're going to talk about why that happens, what volatility really is, and how you can face any market condition with more clarity and less fear, and maybe even benefit from it. First, the reality. Crypto and volatility go hand in hand. That's not automatically bad. The same volatility that scares people is what creates the huge moves everyone gets excited about. It's just also the part people forget the fastest when everything's going up. So, when the market snaps back, it stings. Prices can drop fast and it feels rough in the moment. But here's the thing. The exact same environment that makes some people panic is what others see as an opportunity. 2025 is a perfect example to illustrate this. In early October, Bitcoin hit a new all-time high of around $126,000. Within weeks, it had fallen by roughly a third, briefly dipping into the mid-80,000 range. More than $1 trillion in value was wiped out, and sentiment flipped from excitement to extreme fear almost overnight. The volatility continued into November, with Bitcoin down around 17% for the month. There wasn't one single cause, but expectations around interest rates, worries about liquidity, ETF outflows, and mixed economic data kept investors on edge. Together, they added up to one thing: uncertainty. And when uncertainty rises, more people sell than buy, and prices can drop quickly. Bitcoin has bounced off those lows and started to stabilize, which is a good reminder that even sharp drops can be followed by periods of recovery. But volatility isn't just a crypto story. Traditional markets can be just as reactive. When new tariffs were announced back in April, the S&P 500 went through one of its worst stretches in years, with trillions in value wiped out in a matter of days. More recently, worries that AI-related stocks had run too far triggered another pullback. The fundamentals didn't suddenly collapse, but sentiment did, and prices followed. But once emotions settled, the market stabilized and rebounded. And that's the pattern. These aren't one-off events. They show up in every market, and the recoveries always look obvious in hindsight, but almost never feel obvious in the moment. That's why understanding cycles matters. Markets don't move in straight lines. They move in phases. You get a period of steady gains, growing optimism, then sometimes euphoria. That's often followed by a sharp pullback, where fear takes over before the recovery starts. The real question is, who actually sticks around to experience it? Bitcoin's history is a good example. In 2013, it peaked around $1,100, then crashed by about 80%. Many who bought near the top felt doomed and sold in panic. But if you'd simply held from that peak all the way to the most recent highs, you could have turned that $1,100 into well over $100,000. You see the same thing in traditional markets. During the 2008 crisis, the S&P 500 fell more than 50%. Some people panicked and sold near the bottom, but others simply held. A decade later, the market had more than tripled. The people who sold locked in a permanent loss, while the ones who stayed invested turned a brutal moment into long-term growth. Same crash, different behavior, completely different outcome. That's the lesson here. You can't control the market, but you can control how you respond to it. So, how do you deal with volatility without letting fear take over? Well, you need context. Understand that markets move in cycles, not straight lines. Big swings are normal, and the long-term trend is what matters. Right now, the bigger picture is stronger than in past cycles. We have regulated ETFs, more institutional money in the space, and growing excitement around stablecoins and tokenized assets. All of this means more people are getting into crypto and using it in different ways. Once you see that, a sharp drop starts to look like what it really is: a normal part of the cycle, a reset, a breather, a shakeout before the next chapter, and, for some, a chance to get in or add at a better price. Bitcoin advocate Michael Saylor summed that bigger picture up at Binance Blockchain Week 2025 when he suggested people should embrace volatility, not fear it. He told the crowd that volatility isn't a flaw, but proof of relevance, and that the winners will be investors, the digital economy, and Bitcoin holders. How to be a winner? Set a plan when you're calm. Stick to your limits and let the market move without dragging emotions into it. Because in every market, it's the patient, steady investors who tend to come out ahead. And volatility is the test that decides whether you're one of them.